Hope everyone had a wonderful weekend. I don't know if you guys felt we just had a big earthquake out here, and I think the epicenter was South Pasadena. And we're here on the fifth floor, so we felt it pretty heavy, but we're all good. And just wanted to share that with you guys. So let's talk about refinances. Let me go ahead and get my slides ready. I did prepare some slides for this presentation, and I want to kind of get everyone thinking about uh, uh, the refinances, right? I know we haven't really been talking about that much because it hasn't been really relevant, especially with the rates being the way they are, and not a lot of people motivated to refinance right now, right? But I know that's about to change. I think we're all sensing that as well. I've had customers reach out. I'm sure some of you guys had customers reach out, at least inquiring about the interest rates, right? So so something that I want to start preparing everyone, at least get everyone mentally prepared and start thinking about these opportunities, because they're not gonna look the way you think they are, where people may just call you and say, hey, I want to refinance, right? Hold on, give me 1 second so I could share my screen. Can you guys see that?
Yes, we could see it.
Yes, we can see that.
Okay, perfect, perfect. All right. Again,
Yes.
thank you guys so much. All right, and if you guys don't mind muting yourself so we don't get any background interference, and I'll open it up to Q and A. And if you have any questions along the way, just go ahead and unmute yourself and ask questions. We'll do this kind of like a townhouse type of meeting, town hall meeting. I want to answer as many questions as possible, right? So let's talk about refinancing, right? And the cool thing about refinances versus doing a purchase is that once a borrower commits, you're going to be able to close in weeks. I mean, you could even close them in a week if all the conditions are correct, right? Let's say you get appraisal waiver. Uh, that's going to be huge. You don't have to order appraisal. You pretty much disclose, get the loan approved, and then pretty much get it to docs. And we've done that before. We've gotten CTCs in 3-4 days, 5 days on refinances. And this is why it's very important that you guys get familiar with operating AUS. AUS is going to help you with seeing if you can get appraisal waivers, especially if you're running both engines, right? You're running LPA, which is Freddie Mac system, or Fannie Mae system, which is DU. And DU may not waive the appraisal, but maybe LPA will waive it, right? So that's why you always want to run both engines, because appraisal waivers are the best thing that you can get on any loan. And what that translates for you is a super fast closing, because you're not waiting for an appraisal to go out there and appraise the property. And in most cases, where you're going to find this at is in refinances, especially rate and term, right? There's a couple of refinances. You can do rate and term or a cash out. And with the rate and term, all the borrower's really doing is uh, uh, lowering either the payment or the rate or the term, right? They're going from a 30-year fixed to a 15-year fixed. And that's the opportunity there for them to either save money by reducing the rate or the amount of time that they're going to have the loan. All right. Can you guys see the screen right there, right? Key advantages of refinancing. Okay, perfect.
Yes.
All right, so these are some of the advantages that I came up with refinancing, right? Increased revenue. It often results in a loan origination fee, so it can be a significant source of income for loan officers, right? And in this case, you guys can also do correspondent and do what's called no closing costs refinances. And a little later, I'll get into a couple of examples of that, of how that's going to work and how that can be very beneficial, and why these third-party vendors that we have charging lower escrow and title fees is going to make a huge difference, not only for your borrowers but for yourself when you're making a commission, right? So client retention and loyalty. um, Successfully refinancing a client's home can enhance the loan officer reputation, and it also helps you spread the word, right? If you refinance, someone's house, they may have brothers, sisters, and be like, wow, you know what, I just saved all this money. You should call Pablo or whoever to refinance, and you'll get a lot of referrals that way. And the good thing about refinances when the rates drop is mathematically they're no brainers. And what that means is that math doesn't really lie, right? 2 plus 2 is always going to equal 4, and 4 plus 4 is always going to equal 8, right? Same thing with the numbers that you're going to present to your borrower when doing a refinance. A lot of people don't understand the benefits or why they should even refinance, and they think like, oh, you just want to refinance my house, charge me closing costs, and make more money for yourself. But you can show them with visuals, and I'll show you some of the tips that I've done in order to show people that mathematically they're going to be able to save money, and it's not something that they have to make an emotional decision on. It's just honestly a business decision where it's going to save them a lot of money in most cases. And that's what happened in 2021, when COVID hit and the rates dropped right after that. We all got really busy with refinances. We had loan officers making 40, 50, 60,000, $80,000 in 1 month, and consistently every month, because that's how fast the refinances were coming in. I don't know if that's going to happen this time around. I don't know if it's going to be a gradual downward. If it's gradual, it's not going to be as fast as that was, because we had a immediate rate drop from, I think, like in the mid fives or high fives all the way down to like 2, 3%. So you could imagine everyone you talked to, it was just, it made no sense if they didn't refinance. I mean, you had to refinance because you were going to lower either your interest rate or your term. So that's why a lot of people were doing it. And that's why a lot of people don't even think about it. So what's happened to us from 2011 to 2021, right before they dropped, uh, the way a loan officer's pipeline looked, they had a mix of refinances and a mix of purchases that they were working on. At least the loan officers that were well balanced, right? You had refi only loan officers. They don't do purchases. They only work on refis. A lot of those people, they leave the business when that happens, and then they come back when they see the refinance coming, right? But you got to understand, from 2011 to 2000, around 2021, we had a pretty steady flow of business. If you wanted to go out and find refinances, you would be able to find them because the rates were pretty decent. They weren't that bad. And um and people were doing, cash out. They were, doing debt consolidation. They were doing, numerous things with it, right? It wasn't super busy where you were getting tons of refis, but there was movement in the refinance market. Come 2021, then there was a hyper explosive amount of refinances. And usually we like to live through those booms, right? Loan officers look forward to these booms when they happen, because in the 1 or 2 year period that they're happening, you can make tons and tons of money. I mean, life changing money, that is. Me and Steve, I've experienced three already, I think, together. And every time it's been really great for all of us, because it's just, it's just, you're pretty much just writing loans. And the cool thing is that they're not complex, they're not hard, there's no realtors involved. It's just you, the borrower, and your processor trying to get that loan refinance. In most cases, 80, 90% of the times, it's going to be pretty slam dunk easy deals, right? Especially when they're conventional. And a lot of people were switching over from FHA to conventional, and there's going to be a lot of opportunity for that because they want to drop the mortgage insurance. Um, Opportunity for cross selling, right? We can do equity lines. If you're insurance guy, you can also do insurance, whatever, but it just helps you with the bar, right? Um, yeah, and also, just being in the refinance space helps you a lot in building your clientele, your client base, right? So that you get more people in front of you, and you have more opportunities later on to work with more people. You dump into your database, and you just keep building that up. Now you have a good customer database, two, three, 400 thousands of people that you can send flyers to, market to, people that you've helped in the past. And those are people that are going to fall under your refi um, category, right? And everyone that's ever done a loan, by the way, um, uh, at some point is gonna want to refinance. And usually, back in the days, the number was that most people do it within a 5 year period of purchasing their properties. That usually when they end up refinancing. And what are some of the benefits for bars refinancing, right? Uh, I mean, there's so many benefits for them in terms of being able to remodel, open up a business, do all kinds of different things that they want to do. One of the most popular one is going to be the debt consolidation, which I'll kind of show you how that one works when I get into the LendingPad phase of things. But those are the big considerations of why people do that. Sometimes they want to buy more property. I mean, there's so many reasons that you're going to find out that people want to get into refinances, right? And one of them is going to be to access cash, right? They want to get cash, and for whatever reasons, they can be personal, they can be business. A lot of times they'll share it for you. It could be vacations, education. Um, the other main one is just doing a rate and term. Person started off with a 30-year fix at 7%, let's say. Now the rates are at 4 or 3%. Now they want to refinance down to a 15 to try to pay off the home quicker and just lower the rate and term. They don't want to cash out, right? Debt consolidation. A lot of people have been using credit cards, or they just kind of overwhelm, so that their monthly output is being all their monthly income is being sucked up by all their monthly output, right? So all these debts are not allowing them to, they're suffocating them. They're not allowing them to have the extras because they just got really uh, debt heavy. And what the cash out refi or the debt consolidation does for them is they're able to lump all of it together into one loan. And because the mortgage interest rates are much lower than, let's say, credit cards or auto loans and all these other things, then it creates a huge advantage. So you can see a borrower go from, having to pay, let's say, in a car, a few credit cards, let's say it's about $1,200, to maybe dropping that down by putting it into their main home and saving $800-900 a month, that now they have just as disposable income on a monthly basis. And I'll give you more examples of that. I'll give you more visuals on that so you understand what I'm talking about. Home improvements, another huge one. People want to improve their homes, and I think right now there's a huge pent up demand for people wanting to build out their homes. They're figuring out, it's probably cheaper if I keep my house and just make it bigger, add more square footage. And this would be a great opportunity to go and meet contractors and people that are in the home improvement business, and build around them, right? So that um, they can refer business to you when people are looking to do a refinance, to do a remodel or whatever. So contractors are great partners for this. And anything else that you see on here, right? Debt consolidation, maybe talking to financial advisors that have access to clients, and they see that they're just too much debt and they need a refinance that would really help them out at a lower rate. So think about these people, not just realtors that can send business to us, but people that can start sending refinances to us. And you want to start doing that now so that you don't get caught off guard later on. All right. Um, Tax benefits, mortgage interest can be written off. I mean, I can't give tax advice, of course, but that's one of the main reason why people will do borrow against their property, because the mortgage interest is something that you can write off on your taxes, and that creates huge tax benefit for a lot of people. So a lot of them, people won't mind lumping everything together, because unsecured credit cards or revolving credit cards don't give you any tax benefits. You have to put everything together, put it on your property, and then you're able to get that mortgage interest at the end of the year. If you have a mortgage, you get a little document that lets you write off the mortgage interest, and that will be reflected on there. All right, so these are the reasons why people want to refinance and take money out. And you'll hear other weird things too. Well, not weird, but you'll hear other things too, like a few refis that I've done throughout this time that rates were high were people that were getting divorced, right? People that one party was buying out the other, so it was not something they wanted to do, and maybe it wasn't something financially wise at this moment, but it was something that they needed to get done. And there's other things that can come up like that too, right? So that's divorces, unforeseen medical expenses. People get in trouble with the law or whatever, right? And they need to put up their house as collateral or whatever. So there's a lot of different situations, just like in the car accident business. A lot of these remodel shops are in business because accidents happen, right? Well, life happens too for people in life, right? And sometimes we're there and we're able to help them out with these mortgages or these refinances that we're able to do with them. So you guys we're sitting in a really good place to help a lot of people. You just have to understand how you can help people in so many different types of situations with a cash out refinance, right? And again, the main goal is always to try to get them a better rate than what they had, and then try to get them whatever else they need for whatever reason they want it for, right? So there's more uses here. One of the main ones when you do the debt consolidation is going to be the improved cash flow. That was the one that I saw big time when I was doing refinances in 2021. I got people a monthly savings from refinancing to from 5%, 6%, I think $600-700 a month that now they had of disposable income. And this is great because this is disposable income that can be spent in other areas of your life, right? You can spend it in your household items, your vacations, whatever it is, or put it away. But the whole thing is now you have access to that extra money. And for a lot of people that's important, right? It helps them get out of a lot of situations. Let me see what else. And what may happen too is on this last one where it says potential to refinance again. Uh, what may happen is that let's say rates drop down to 4.75. I'm just uh, guessing here. You might get a big flood of people refinancing at that rate, and then let's say 6 months later they drop down to 3.75. So now you can refinance all those people that you just refinanced all over again. You do have to wait 6 months. So remember, we have the one of the things that we have to deal with is the EPOs, early payoffs. If you guys are not familiar with that, EPOs occur when the mortgage is paid in less than 6 months. So a lot of the lenders that we work with, they will make us sign contracts that if any loan is paid off before 6 months, we have to give our commissions back. So in turn, when you onboard with Equity Smart Home Loans, we also have you sign agreements agreeing that you're gonna have if you have an EPO, you have to return the funds. And I think you guys are all aware of that, but it's a good time to remind everyone of this. And I was talking to a loan officer earlier, and one of the concerns that he had was like, "Hey, what happens if I refinance and then, a few months later, someone else refinances, right?" So I do want to talk a little bit about that, so we have that protection. And uh, the EPOs is something to really, be considerate about. And what I'm gonna do is I'm gonna reach out to all the lenders that we have and find out what their EPO policies are, right? And some of the lenders, if you go bar paid, they're not gonna charge you an EPO, right? Meaning that you're charging the points, so you're not making any rebate. So I'm gonna put that list together. We're gonna put on the lender list. We're gonna create a tab so you can see what the EPO guidelines for each lender is. But the best way to get in front of this or get ahead of this is to make sure you talk to your borrowers and understand what their plans are, right? And also let them know that you're going to continuously monitor the interest rates, that they don't need to do anything beforehand, that if anyone tries to reach out to them about refinancing or anything, that you're going to be the one helping them with it, and you're going to be monitoring the interest rate. And if there's an opportunity to refinance again, then you'll be looking out for that. And typically when rates start going down, if they don't just go down suddenly, they're going to go down gradually. So you also want to let customers know, hey, we just refinanced. I got you down to 4.75 as an example, right? And let's say they drop to 4 and someone's asking them, say, well, just wait a little bit because they might even go lower. And then once they're past that 6 month mark, then you can actually talk to them about refinancing, depending on the situation, of course. But best thing to do is monitor your borrowers, make sure you stay on top of them, especially the ones that you are going to refinance, because one thing we don't know is if rates are going to come down slightly or quickly or fast, and that's all going to trigger. Every time it goes down, it's going to trigger different audience of people that are wanting to make some kind of financial move, right? And you know a lot of people don't realize how powerful the movement of rates is, right? And it triggers people to start doing things. And the federal government knows this. That's why they control interest rates, because that's how they're able to control the influx of money going in and out. And so they understand that by lowering the interest rate, it's going to create more volume. It's going to create more activity in the financial sector. And we're the ones caught in the middle of that, which is great for all of us, right? We want to be caught in the middle of something like that. So I'm looking forward to it. I think it's going to be great. And one of the things that happens is once you refinance one person, they're going to refer someone else. And then hopefully you have just like a wildfire. When it starts, it just starts spreading everywhere. And before you know it, you're doing refinances everywhere, right? Um, what I would like to see is, I would like to see, from now on, hopefully a consistent flow of refinances that, uh, uh, that come every month. I don't like these fast fluctuations because I think they hurt us. I like when things are more gradual. And if anyone was doing loans from 2011 all the way to 2020, you know exactly what I'm talking about, because it was a good flow. It wasn't nothing crazy. And then we peaked, of course, in 2021 with the COVID and everything. All right. Any questions about anything I've talked about so far before I get into the next part?
Yeah, I put one in the chat, but I can repeat it.
Yeah, go
If
ahead.
uh, if a loan is coming in from like Rocket Mortgage, for instance, or something, and the borrower wants to refinance before the 6 months, that should be still okay to do, or
If it's an outside, like you're asking if you didn't have nothing to do with it.
correct?
Yeah, if you have nothing to do with it, then you, as long as you didn't originate it, then you're good to go. Yeah, you don't have to worry about it. It's when you're the loan officer and it gets paid off before. Um, that's when we have that issue. All right, so let me jump into LendingPad now really quick so I can show you guys kind of an idea of how to work it in the system. Now, one thing that I was actually surprised to not find in LendingPad, which is a little bit of a bummer, was a debt consolidation tool. So I'm gonna be working with my team to develop some kind of debt consolidation tool. I don't know, Martin, maybe you have one already because you seem to build your stuff out. Yeah, but a debt consolidation tool is gonna help us big time in the sense that you're going to be able to do everything super quickly and put together refinances, especially when they're trying to do cash outs. And I plan to have one. I plan to have something like that, like this, hopefully in the next week or two, that we can roll out for you guys, so that you guys can use that as a tool. But for now, the best thing that we can do on LendingPad is, so this is your, I'm on the overview screen. The main difference that you're going to have is when you're here on the left, when you're editing, instead of putting a purchase, you're going to do cash out refinance, or if it's a rate and term, you're going to do no cash out, refinance. So you get to select. Um, it's usually you can do cash outs on investments and stuff like that. It's going to be a little harder, but you can do that. So just make sure you have the residence correct, the loan amount that you want. Make sure you select the program by clicking on these little wavy things here, and making sure whether you want to go 30-year, 20-year fixed. And sometimes people just want to lower the term also. And by the way, if you guys are not aware, the 15-year rates are always lower than the 30-year rates by maybe like half a point to 3/4 of a point. So if the customer's even trying to get a lower rate, you want to look at the 15-year rates, and you probably get the bar a better interest rate by doing that. So make sure you're looking at all terms. You can look at 15, 20. A lot of the pricers that we have with the lenders that we work with, they allow you to uh, do different scenarios, right? So you can do like up to three, and you can compare them against one another to see which one might make the most sense. And sometimes it's great to present a couple options to your borrowers, right? Uh, when I take the applications, I always try to find out like what their goals are. Like you got to listen very intently and make sure that you're understanding why they want this money or what they want to do this for. And some of the mistakes that loan officers make is that they kind of say, well, I think you should be doing this, and kind of push their own agenda, when in reality you should be really listening to your borrower's needs. And if they're telling you, I don't want any money, I don't want any rate, I just want to lower my term or my rate, then stay focused on that. Don't try to get them to cash out. I know that cashing out sometimes helps us out because the bigger the loan amount, the bigger the commission check, right? Of course. But just one of the things that I've done is just listen to my customers' needs. And I know that sounds very basic, but trust me, that goes a long ways. Customers like to be heard, and they like for them to know that you listen, and kind of going along with them. And it's okay to share ideas with them, but don't force anything on them. All right, so getting back over here. So normally what I do is, if I have a customer, they're going to give me a copy of their mortgage statement, right? Especially when I do a refinance. The first thing I want to see before anything is a mortgage statement. Step one, get a mortgage statement. You don't need to take the application. You don't need to do anything else but get a copy of that mortgage statement. The reason I like the mortgage statement is because it gives you a lot of information. It gives you how much they owe, how much is how many months they've paid already, how many what the current interest rate is. So everything you need to know to try to win that deal or create a scenario that's going to help that borrower improve their situation is going to be on that mortgage statement. And that's going to allow you to kind of get a head start. And with phones now, you can even ask them, if you don't want to wait for an email, say, hey, do you mind taking out your phone and taking a copy of that mortgage statement? Have them text it to you. Don't wait, because the sooner you get to them, the sooner you can help them and the sooner you can get that deal closed. So get that mortgage statement, and what you want to do, what you want to figure out is what interest rate they have and what interest rate you can get them, right? So if they have a high interest rate at 8%, then it's going to be a no-brainer for you to help them out because rates are much lower than that, right? The next thing you're going to want to do is make sure what type of equity they have, right? So I like using United Wholesale Mortgage's AVM. If you haven't used it yet, it's a pretty cool system that they have. And let me actually just share that with you really quick. So I can show you guys, because this is going to be an important tool for refinances. And if you go right here to the bottom where it says home value estimator, you're just going to plug in the address. And if you haven't used this already, go in there and play with it. Just run a scenario with your own property so you start getting familiar with it. I like this because I feel this is a little bit more accurate than Zillow or any other systems out there, because you want to see how much equity they have in the property. And in some cases, they might have bought the house like less than a year ago, and depending on the neighborhood, they may have more equity than they realize, or maybe they don't. And so that we want to kind of get to the bottom of this, right? So the home value estimator is going to give you a window of between 1.3, like in this, for example, this particular property is going to be 1.4 to all the way to almost 1.9, right? And then you can look up the actual PDF, and now you can determine exactly what you feel comfortable, the value that you want to give the value to this property. My advice is when you're running DU and LP, because you're going to have to run DU and LP at some point, whether it's through our system or whatever lender you're going to use. You want to look at the very first page where it says recent comparables. Excuse me. And the first property is going to be our property, the subject, right? And the rest are going to be close comps. And what you want to do is you want to identify your property right here on the map, so that you can see how close and similar these other properties are. I like the color coding. Color coding means that it's highly similar. So number one is going to be a very similar comp. And that one looks like it was not even a quarter of a mile away. And it was listed for 1.753 million. And it closed on 224 for the same amount. And it almost has everything identical if you look at the bedroom, bathroom count, lot size, and everything. So you can probably safely say that the property is at least worth 1.7 right at this point. If you're, and I want you guys to pay attention to this carefully, when you're running DU and LP, if in this case, if the loan amount was only 500,000, I don't need to go as high as 1.7. I don't need to push the value. In fact, I want to do quite the opposite. What I want to do is when I'm running AUS, I want to just find where the 60% LTV, right? So I'll give you an example. So in this case, we determined that the property is roughly worth about 1.7. We don't need that much value because we're only refinancing 500,000, right? And I want to keep it at 60%. So I'm probably going to run LP or DU at 1.3 million, which is way below the value. And the reason why is because I'm gonna improve my chances of getting an appraisal waiver, because the pricing is going to be the same whether I'm at if I'm as long as I'm below 60% LTV, then the pricing on the interest rates is going to be the same. So why try to max it out when I don't have to, and then give myself a better chance of getting a DU or an LP appraisal waiver? And when you get those waivers, again, they're the best. you're mostly gonna get them on rate and terms. You will get them on cash outs, but I see them more frequently on rate and term refinances. And that's really what you're shooting for, is trying to get that appraisal waiver. If you can, if you're at a high LTV, like let's say 75 or greater, it's going to be a little bit tougher to get them, but you can get them, right? And in some cases you may want to push the value. So just remember, you can do that. You can, play with the value depending on what the whole situation looks like. And if you have questions more about that, you can ask about that on the Q&A, and I'll try to clarify it a little bit better. But you're going to use this tool. All right, let me go back let's go back to, where was I at? LendingPad. All right, so we're back at LendingPad. And so what I like to do is I like to get the mortgage statement. I like to get the value. And then I'll, once the application is completed, I'm going to go in here. And, I could say in this, for example, the loan amount's 500,000. I'm going to say that the property is worth, let's say, 1.3 million, right? And the reason I want to do that is because I want to keep myself as, closer to 60% LTV, so I can get the appraisal waiver, right? I could even probably go lower, right? I can go to like 1.2, whatever, or 1.1. But you guys get the point, right? And the reason I'm doing this backwards is because I want to get those waivers. All right, so once I've done this, I got my value, I got my loan amount, then I'll take the borrower's interest rate. So let's say that the borrower is at 8.25, right? So I'll put 8.25 in here, and let's pretend I looked at the borrower's mortgage statement, and they got the loan 5 years ago, right? So hold on. So we're gonna put, we'll put like 289 months. We'll say like a little bit over 5 years. But about 289 payments left on their current mortgage, and I know that because I got their mortgage statement, right? So I'm gonna hit save, and let's say that their loan amount, let's say that their loan amount is 400, right? But they want a loan amount of 500 because they want to pay off some bills. So it's gonna be 400,000. I'm gonna go ahead and hit save. All right. And then I'm going to make sure I have everything correct. So I have 8.25, 289 months left. And then I'm going to go to disclosures. And I'm going to go to amortization. And I'm going to pull up their amortization so I could see how much interest they're going to pay for the remaining life of their loan, right? And I want to be able to calculate this so I know exactly what they're going to pay for interest for the remaining life of their loan based on that interest rate, right? And the reason I'm going to do that is because I'm going to take the next thing I'm going to do is I'm going to go ahead and look and see what it's going to look like for them at 500,000. So then I'm going to go back to overview. So I have it here, right? I have it here. And then I'm going to go back to back over here, and then I'm going to pretend like I already priced this loan out. And by doing the refinance, I can now get them let's say 5.25, right? And I'm going to do it for 15 years. So it's going to be 180 months. So then I hit save, and then I'm going to go back to the disclosures. I'm going to create this amortization schedule. And then I'm gonna I can email this to the borrower, and then also create a in the body of the email. I can create kind of like a condensed version of what I'm sending, what they're gonna find within the stuff that I'm sending them. And this is all math, right? So when you look at this amortization, you can see that the first payment, 5.25, 1750 is going into interest, and then 1465 is going to principal, right? Total payment is 3,200. Over here, let's go back to the top. Over here this should be the 8.25. It's the payment's almost the same, 3,200, but 2,700 is going to interest, and this is how much is going into principal. You guys see that?
Yes, we can.
Okay, cool. So then just looking at this, the 2750 at the higher rate is, I mean, it's gonna be a wow, like the customer's gonna go, that's crazy. Look at the difference, right? But the customer did ask us for 500,000. We're not gonna, I just wanted to compare the 400 to 400. So now we gotta go back and just change it over to, oops, we're gonna change it to 500 because that's what they asked for, right? Because they wanna pay off some bills. And what you're gonna do is you're gonna find out how much cash. Well, before I get into that, I just want to show you this, and then I'll jump into that. I don't want to be all over the place. All right, so then we go to the amortization schedule, 5.25, and again, all this rates and stuff is incorrect. I just want to be clear on that. I'm just kind of using these as an example so you understand how the math can help you, right? So now at 5.25, payment's going to be 4,000 because the interest, I'm sorry, that we reduced the term to 15 years. So we're comparing a 15-year loan to a 289 loan, right? So now 2,100 goes into interest and 1,800 goes to principal. The loan that they have right now at 8.25 is they're paying 2,750. They're still going to be paying less interest, and they're going to be cashing out, and they're going to have a higher loan amount. You see that? So once a customer starts looking at these numbers, it becomes almost a no-brainer. And what you want to do is you want to create an email that kind of summarizes all this, lets them know how much they're going to save for the life of the loan in both cases, so that they can just compare apple to apple and see that they don't even have to think about this. You already did all the thinking for them. All they have to do is verify, confirm, and then give you the green light to move forward with the refinance. The more you put in front of the borrower in terms of them understanding, then they're going to be more inclined to work with you and move forward. A lot of loan officers are not going to give them this type of breakdown. But in order for you guys to derive at all this and making sure that they're going to cash out the correct loan amount, we have to go through several steps right now. Versus if they had a dedicated debt consolidation screen within their system, then it would be a lot easier for me to show you guys. And my goal is to get that. In the meantime, I'm going to have my team build something out that's going to look something like this. And that's going to help you quickly determine, being able to pay off the debts, determine how much cash out, including all the closing costs and everything. So you get the correct amount, and that's what's important, that we get the correct amount. Because what happens is that if the customer tells you they want 100 grand after they pay off their bills and everything, you want to make sure that that's what they're left with at the very end. So you're going to need to factor, your closing costs. So one thing I do want you guys to do on refinances is make sure you complete your fee sheet, which I'll show you in a second, because you need to find out exactly what the fees are going to be so that you can incorporate everything. And then also, when you order the payoff, you're not going to have the payoff. So what's going to happen is when you look at the loan application, you pull the credit, you go into the liability screen, you're going to see a mortgage balance. And it's going to say, for example, in this example, I put on here in my liability screen, I have a loan with United Wholesale Mortgage for 400,000. Well, when I order the payoff, it's not going to be 400,000. It's going to be like 402, 403. So I have to cushion for that. And sometimes what I would do is I'd go in here, even though I didn't have the payoff, just so that, I'd rather be over than under. Because the last thing I want is a customer signing loan docs and they wanted 100 grand and now they're only getting 89 grand because I didn't calculate things correctly, right? So now I'll even go as far as going in here and putting 402, right? Maybe 402, 500, just to build a cushion, right? Because remember, the credit reports are a month or two behind sometimes in what the balance is. And so then I got myself covered there. So now I know that by increasing the mortgage payment, my home balance by one mortgage payment, then I'm going to be covered when when the processor orders the payoff, then I should be good. I'm not going to be short there. The next thing I'm going to want to do is go to disclosures and then make sure that all my fees are right. And now you can do this thing where here in the bottom, you can select the lender and it'll pop up their fees. So that'll help you out. And the fees at refinances are pretty simple. They're not that complicated. If you're working with Atlas Title, very simple. You know, you're gonna charge if you want to charge a point. In this case, I put 1% of the loan amount. I put that there, so it's $5,000. Underwriting fee, and then appraisal fee, credit report, MERS if you're going correspondent, and then you're gonna have your escrow and title fee, right? So total costs in this example are going to be $7,500. So I want to make sure those are factored in there too, right? So I got my closing costs in there. I got the other part in there as well. So now I can go to which one was I looking at? Let me see. Let me look at this one really quick. And then I could see that my customer is going to cash out $60,000. You see that? But he told me he wanted 100 grand after he paid off his debt, right? So I'm like, shoot, I'm short. I only have, he wants 100 and I want 60,000. So what I did is I went in here. He told me I want all my debts paid off, plus I want 100 grand, right? So then I go back to the application. I go to liabilities. And then I just make sure everything's paid off. So if you look right here, everything's marked off, paid off. So we're paying everything off. So then I need to add 40,000 to the loan amount, right? So I'm going to go back to overview. I'm going to hit edit. And I'm just going to change the loan amount to 540. Right? Let's see what that does. Or maybe even cushion a little bit more. Let's do 545. We're going to hit save. And by the way, a good debt consolidation screen we wouldn't have to do all this back and forth like what I'm doing now, but this is what we got to work with. So we got to make it work. All right. So then we go back to, now we can go back to disclosures and see if, how it looks now, right? And this is something we can always send to the bar too, the fee worksheet. You can do it the same way you do on a purchase. That way they have an idea what the costs are going to be, right? So now I corrected the amount. I was able to pay off all the bills and then get them a cash out. What I would like to see in this form is I would like for the borrower to see on here what we're paying off, but LendingPad doesn't have that. Like, you know, we're paying off the house, we're paying off the credit card, like a line item showing what's being paid off. So that way the customer is clear on exactly where all the money is going, what the closing costs are, what the prepaids are, and what we're paying off on the mortgage. And then up here, they're going to have everything they need to know, right? Cash out refi, loan amount 545, and then what the interest rate is going to look like, and also the terms. But this is a quick way. I mean, it's not too long. It's, you know, that's why I wanted to show it to you guys. But the main thing you want to look at too when you're selling this stuff is how much money, how much are they going to save either in interest or the payment, right? So and that's something that customers look at closely as well. So you just want to make sure you have that covered. So this is the way you're going to be able to put it together. Step one, get a copy of the mortgage statement, recreate their amortization so you know exactly what they're paying in interest and everything for the life of the loan and on a monthly basis. And then from there, you can start realizing what type of loan you want to get them or give them a separate options, right? So the customer can come back at me and say, you know what, you know, the payment's $5,281. Can I just go back to a 30-year? I'm okay with that. And they'll do that to you. And they'll say, okay, cool. Don't worry about it. So then you're going to come in here, hit edit. And then all you simply have to do is reprice it, of course. Rate's going to be higher because it's a 30-year fix. So let's say it jumps to 5.75. And then we're going to go to 360 months. You're going to hit save. And now their payment dropped by like, what, $1,100 or something like that. So now it's 4,080. And then you can always go back and look at the amortization, right? And see how much interest they're paying per month. And it should be lower than what they were paying before, even at a higher loan amount, right? So it's 2611. They're going to be paying 2611 in interest. And before they were paying 2750. But they were paying $2,750 at a $400,000 loan amount and with no cash out. Now they're paying $2,187 in interest and it drops, of course, every month. So they're still paying $500-600 less, or $400 or $500 less in interest than they were on their original loan. And this loan is now for $500,000, and the rates, well, I'm sorry, this is it, 2611. So it's almost the same, because the rate, we had to bump up the rate because it was at 5.75 because it's a 30-year loan. So that's pretty much it in a nutshell. Like the main things I wanted to go over. I want to open it up for any questions. So let me see if there's any questions on the Q&A. All right, I don't really see anything on there. So anyone have any questions about anything to do with refinances and how to get them going, how to look out for them?
Yeah, hi Pablo, can you hear me?
Yes.
Yeah, I have one borrower that wants to do a cash out refi on a investment property. You mentioned something about there being a little more complexity to that.
Yeah, it's just lower LTVs, and then
Okay.
the rates are going to be higher because it's an investment. So you just got to price it out. So on a cash out refi, you might be max at 70% LTV or something like that, depending on the property type and all that, you know. So when you use a price, I haven't done one in a while, so I don't know exactly what the cutoff is, but if I remember correctly, it was somewhere between 70 and 75 on a 1 to 2 unit, and I think on a 3 to 4 it went I think you had to be below 70. If anyone knows or could correct me, please feel free to do so. But you can do them, and then keep in mind you have to have reserves too. So for that property and the primary property as well.
Okay, so you're saying the reserves on his primary property, it's where he lives, he resides, right?
Yeah.
Is that what you're looking at?
Yeah. So like, for example, if he's from whatever I remember correctly, if let's say he's refinancing an investment, a 2-unit property, the DU is probably going to want 6 months reserves for of PITI for the main property, or is it 3 or 6 months, something like that. So you're probably going to need that as well. But once you run DU and LP, it'll tell you exactly what you need. But you will need reserves.
All right, great. Thanks. Appreciate it.
Yeah. And make sure you use your take. Oh, I forgot one thing I wanted to show you guys. So on the no closing, one of the advantages that we have as being correspondent, you guys can see this, right? The United Wholesale Mortgage.
Yes, we can see your screen.
Okay, perfect. Just want to make sure. You're gonna come into the pricer, and let's just do that scenario really quick. It's just so we have an idea. So I'm gonna do Pablo Martinez, and we'll just put refinance Joe. All right, so we'll do conventional loan amount. We said 540, and we're gonna do a value. We're not gonna put a sales price because we're not doing a purchase. We're gonna put a value of 1.3 million, and it's gonna give us the LTV at 41. It's gonna be a refinance mortgage, and it's gonna give you options, right? These are all the reasons, all the things that you can pick. This one's gonna be rate and term, right? Or I'm sorry, rate and term or cash out, and we'll just put other. And single family residence, properties in California. We'll put LA County, and I'm only filling out the stuff that's in asterisk that's required to be filled out. And we'll do 22-day lock because we get 5-day free extensions. And then the cool thing here too is you can actually spit out, like if you want to do 15-year, a 20-year. So probably the most popular ones, 15, 20, and 30-year. That way you look at all the options and then hit get quote. So so we have all our rates right here, right? So we have the 30-year, and that one's gonna be at 6.125 is giving a small rebate. So that's gonna kind of be their par pricing right there, right? If they want to go 30-year fixed. If they want to go 20-year fixed, it just drops an eighth, it looks like. So it's going to be 5.875. And then if they go 15-year, then the rate's going to be at a lot better. It's going to be at 5.3, 5.5. You could probably shop around and get a little bit better, but you get the point, right? So the way that no closing costs would work is, let's say that the bar says, let's say the bar's at 9%, right? I don't know how attractive this is going to sound for bar, but they're at 9%. You can select 6.125 with the 7,700 rebate. I mean, $7,007 rebate. And the only cost that the bar is going to have is going to be the underwriting fee. Let's say there's no appraisal because it's going to get an appraisal waiver. And then they're going to have their escrow and title. And remember, we have partnership with Atlas Title and another company where the escrow fee is only $350, and the title fee is going to be based on the loan amount. But it was something like this would probably be like $500 or $600. But you're going to be able to keep your escrow and title fees under like $1,100. So the goal being is that, let's say you keep your cost to about $4,000. What's left is about $3,700, and that would be your commission, and that would be so that the bar is not paying any closing costs. You're wiping out their whole closing costs, so you make it extra juicy for them to refinance. You say, you know what, we're not going to increase your loan amount by any of our closing costs, because we're actually going to pay for them. And the only thing your loan amount's going to go up by is maybe 1 month's mortgage payment to cover the payoff, and that's it. And that's how you can drum up some business, because when the bar looks at this, they're gonna be like, wait, I don't have any closing costs at all. Yeah, we're not gonna pile anything onto your loan, but whatever's left of this $7,763 is gonna go towards your commission, right? Because you're not gonna charge them anything up front. And you're thinking, well, why would I want to do a loan for $3,700? Trust me, when you do a rate and term refi, you're probably not gonna talk to the bars again until the thing's closing. And if that, you're probably gonna do 2 hours of hard work on this, and that's it. So 3,700. 2 hours of hard work is simple math. I mean, you can do that. So look out for those opportunities, and you can also do it at at 6.3, 8,000, 9,000, and that's going to be true, right? Maybe the no closing cost refis are not looking too attractive right now because the rates would have to really go a lot lower. But you can do a situation where maybe, for example, on a 20-year, you can do let's say a 5.99. and cover all their hard closing costs, right? And then charge them a point in the front and say, hey, you can pay this out of pocket. We won't roll anything into your loan, and I'll give you $3,500, and then you can at least make $5,000 on it, or however you want to charge, right? So just giving you ideas. But you're able to use this to help you facilitate a no closing cost refi. Because again, these are not purchases. We're not looking to make a killing per loan. What you want is a bunch of these loans, right? Obviously, the more complex the loan is and the more time you have to invest in it, then you definitely want to charge more. But I'm just giving you, and you're going to know that because you're going to know what type of loan you're dealing with. But if it's a straight up rate and term refi and you're just rewriting it and it's going to close in 15 days or less, then do something like this. It'll go a long ways, and it'll help you it'll give you an edge over a lot of your competitors, because they won't be able to do this. They don't even have the mechanisms to do this. You guys have them in your fingertips, and it's just a matter of how you're going to structure the deal and present it to the borrower. Anyone have any questions about what I just explained, or does anyone want me to explain it a little bit different so they fully grasp it?
I'd like you to explain it just a little different, please.
Okay. Can you start with a question, like what part? Rose?
I guess, yes. So I just want to make sure that I have a full understanding of what the fees are. So when I'm looking at these rebates, I am certain that the fees are going to be covered and that there's a little left over for my commission too.
Yeah.
If
so
I want to truly give them a zero cost refi, like how do I make it most beneficial to them and to me?
Got it. Okay. So what you want to do is you want to figure out what the hard costs are going to be, right? So then you're going to go back to LendingPad, and that's why you want to fill out your fees right here, right? You want to make sure you're going to be on the disclosure section, and you want to fill out all your fees. So you want to make sure you have your accounting for your appraisal, your credit report. You might not have and actually, by the way, if the customer gives you the application and everything, you can run DU and everything and know you're going to have an appraisal waiver before you even have it, before you even start the process. And that way, you know whether to take that out or incorporate that in there, right? And you could tell them this is going to be an out-of-pocket, the appraisal. But anyhow, you put all your fees in here, right? And in this case, my fees are coming out to $8,000 because I'm charging 1 point in the front, right? So you see that? But if I wasn't charging that, let's get rid of that really quick. So if I wasn't charging that, the fees would significantly lower. These are like the bare bone fees that are needed to collect. I mean, are needed to do the loan. Now, the hazard insurance, I'm not going to put that. I'm going to omit this really quick because that's something the borrower has to pay. I'm not going to pay for stuff that he has to pay. You get it? I'm only going to pay for closing costs, loan, escrow, and title. So hold on, it didn't remove it.
Pablo, is it best to do it at borrower paid when you do this so you can see it, see the numbers rather than
You can structure it in it just depends on the scenario. The scenario is going to tell you the best way to structure it. Like, let the scenario kind of guide you. So in this case, I mean, I don't know why the 1800 is not coming up, but I don't want to spend more time. But if I back out the 1800 from the 4362, it's gonna be, the closing costs are gonna be about 3,000, because the only thing I'm missing on here now is just the processing fee, right? So let's edit that, and we'll just put 895. All right, we'll hit save. So then I'm just gonna back out this 1800 because I'm not sure how to get it out. So then total fees are 5257 minus 1800. That's about 3400. So and that's roughly what it's gonna be. Kind of your refis rate in terms are gonna probably fall at about 3,000 to 4,000 in total costs. So when you go back to your interest rate, so then I know at 5.99, I'm gonna cover at that rebate, I'm gonna be able to cover all their closing costs and then charge them maybe a point in the front or something. You know, I can work with that, or I can go to like say 6.5, and then I know from that 9,200 I can pay the 3,500, and then whatever's left is gonna go towards my commission. That makes sense? So
It does. I mean, at the 6.5 rate, I mean, if we're just talking today's market, I don't know how competitive that is. Like, so I feel like I need to go leaner.
Yeah,
But I
no,
see your point. Yeah, I see your point.
Yeah, that might not work now, by the way. But I want to get you guys kind of heads up on the possibility. So if the rates were to drop, let's say another whole percentage point, so then this would be 5.5. So then now there might be people that are 7% that might consider that and say, wow, you're not going to charge me any closing costs, and you're still going to make $6,000 on it. You get it? I just, the whole point of this is to get you to start thinking about these opportunities and be looking out for them. So so that way, you know, you're thinking about them now and not waiting later on, like, wow, why didn't I know this? Like, how come I didn't, you know, look for this opportunity before, right? Because now when you're dealing with the refi market, you're going to work more as a mortgage advisor, as someone that's kind of guiding and letting the customer know, like, hey, this is, I figured out some strategies for you so that you can accomplish paying off your debts, getting the money you need. And for me, I boiled it down to these two options: either go with a 15-year or a 20-year, and these are the reasons why. And then at the end, the customer can decide what they want to do, right? And you can tell them the reason why is because you're going to get the money that you want. You're going to be able to pay off the loan as quicker than you want if you're going back to a 30-year loan, and then you're going to be debt free. So, you know, you're going to be giving them all the points that they wanted, and say, okay, great, that sounds like a good plan, right? You don't have to do no closing costs. You can always bake the closing costs back into the loan, right? So going back to this example, right, that I was doing for myself. So I said that the customer wanted 100,000, right? So he says, hey, well, just roll the closing costs into the loan. I already know that this loan's going to be tougher. So then I already know that I need to collect 4,000 or 5,000. but I did this in a way where it's already taking that into account, right? So, so when you look at the amount that he's going to cash out, it's 104, and that's going to be enough to cover the closing costs. What I can do is I can continue to increase the loan amount to cover any additional. So let's say I wanted to charge him an 1 point, right? So that's $5,000. And in order to cover that point, all I need to do is increase the loan amount by that much more, right? So then I go here, I go 545. So now I'm gonna go to 550. I'll just show you guys this as a quick example. I'm gonna save that. And then I'm gonna go over here to disclosures. And then I'm gonna put back my origination fee. So I'm gonna put amount, and we'll put 5,000, right? So now I'm charging them the 5,000, right? And I think I already had done this, so maybe it's gonna come out the same because I had taken it out, but we'll take a look. Hit save. And now I know that I covered the 5,000 with the loan amount because it's gonna cover it, right? And then I just go here and just make sure that, see what he's gonna cash out. And it's true for any amount, right? So now I have a cushion of 5,000. Remember, I had a cushion of 4,000 or 5,000 in there, and now I added another 5,000. So now the customer's gonna get, well, they're not gonna get 110, but the 5,000 is gonna go towards the closing costs. You see that? And I think I upped it. It was already factored in there. So there's an item in here for 8,457. So the reason it's 110 is because I already had upped it from earlier. I forgot, but you get my point, right? So if the customer I'll just do it one more time. The customer, let's say you're charging them 10,000, then it's gonna drop the amount, right? And the closing costs are gonna go up. So then we're charging them a $10,000 origination fee. Let's just say it's a complex loan. We come in here. And so now instead of the closing costs being 8,000, now they're 13,000. See that? And this should be enough to cover the mortgage, and we have a cushion in there in case, you know, there's unforeseen fees that come up in terms of paying off the loan. All right, I'm gonna do a part 2 next week on this whole refi thing, but I just kind of wanted you guys to get thinking about it. Any last questions before we go? I know we're at the top of the hour.
Pablo, are you going to make this video available to us?
Yes, we record all these videos that we're doing. By the way, they're always recorded, and they're always going to be in the training rooms. As a matter of fact, let me show you where. So this is our portal, right? The portal that you guys have access to, and you're going to go right here where it says the training room. You're going to go to video library, and all the videos that we've ever done in these trainings are going to be on here. And all kinds of different trainings. So make sure you're taking advantage of this. Get more familiar with LendingPad. Get more familiar with your LOS system, but you'll find them all in here. All right. Any other questions? All right. I promise you, I'm going to work on something cool with the debt consolidation, so that we avoid all this back and forth that I just showed you. It's going to be a lot easier. What I have in my mind to be able to explain this to you a little bit better, and it would be way more powerful tool for all of us when we're putting these refinances together. And it also allows me to explain it a lot cleaner and better because it just gives you a really good visual. So I'm going to be working on that, making sure I make that happen. And we have a little bit of time because it's going to take a minute before the rates go down. So I want to get that in front of us before that happens, and then I'll do a training on that tool so you guys know how to use it and how to actually prepare these refinances, and it makes it a whole lot easier for you guys. All right, no more questions. Thank you guys so much. You guys can always reach out to me, email me, text me, call me. Thank you so much. I'll see you guys next week. Enjoy the rest of your week. Thank you.